Okay, hello everybody. This is week 16, believe it or not, the last week of the semester. So I'm going to start by covering a couple things and then we'll get into our final chapter. The course project, for future viewers, after spring of 2023, this may or may not be accurate, but for spring of 2023, the course project was due 2 days ago. And so hopefully you got yours submitted. If not, the sooner you get it in, the better. So make sure you submit it by the end of the course, which again, for spring 2023, that's going to be May the 20th, which is this coming Saturday. Okay. In future semesters, whatever is the last day of the semester, make sure you get that course project turned in if you haven't already done so. And if any questions arise or if you have any difficulty submitting it, just email me and I will assist you with that. I wanted to point out we do have a final course survey. So from chapter 16, just go to the very first link here and spend a few minutes providing your feedback on the course overall. I really appreciate that. I do look at the feedback. Of course, it's anonymous when I get it, so I don't know who said what, but I do use that to improve my courses. So please take some time to complete that survey. Oh, okay. Closed the wrong tab, but that's okay. We do have our final video discussion this week as well. So if you haven't already, start posting to that and post your replies. The posts are all due by Saturday, again, the last day of the semester. So make sure you get those in. And then let's see, the final exam also due by the end of the semester. The final exam is like the midterm. It's 50 multiple choice questions and you get one attempt. It's worth up to 7 points. You have 3 hours to complete it, which for most students is plenty of time. It is open book, of course. As a reminder, in the textbook, there is an answer key that gives answers to some of the questions. However, the numbering in the textbook is different from the numbering in Canvas. So you kind of have to cross-reference to see, you have to compare the answer key to the multiple choice questions in the chapter of the textbook, and then compare that with the questions that are in Canvas. So if you want to do that to double check your answers, you are welcome to do that. What else did I want to say? It does cover all 16 chapters. Mostly the questions are going to come from chapters 9 through 16. Okay. And they will all be questions you've seen on previous chapter quizzes. There will be some questions from chapters 1 through 8, though. So I think that's everything on the midterm. Again, email me if any questions or issues arise. I want to point out that for chapter 16, we do have some accounting stuff videos. So from the accounting stuff page, if you scroll all the way down to chapter 16, which is near the bottom, you'll see there's a general video on the cash flow statements, which is the topic of our chapter. And that one also goes into a little bit of depth on the direct method. But then you have a video just about what's called the direct method, and you have another video about the indirect method. So we're going to go through both of those as we work through the exercise set and the problem set. Well, I might as well explain it now. The statement of cash flows has 3 sections. Operating cash flows, which is any cash that came in or went out in relation to either the sales or production of the products or services. or really just the operation of the business. So most of the cash flow is just related to operations. Companies also have some cash flow related to investing activities. Investing is buying stocks or bonds in other companies, but it's also investing in capital assets for your own company. So for example, buying equipment for your company, buying buildings or land or vehicles, all of those would be investments into your own company. Okay, so whether you're investing in another company or investing in capital for your own company, either way, that would be investing. The third type of cash flow is financing. And this would be borrowing money, issuing bonds, which is a form of borrowing money, and also issuing stock. Those would all generate cash coming in. Any payments to repay those debts or to pay out dividends to investors or to pay interest, all of that would be also part of financing, okay? So the three areas of cash flow on the cash flow statement are operating, investing, and financing. It's the operating section that has an indirect method and a direct method. So that's what's covered here in these accounting stuff videos. Okay, the indirect and direct method of the operating section. The other two sections, investing and financing, there's only one way to do each one, so we don't have to worry about multiple methods. Now, below chapter 16, there are some general accounting videos you might find useful as well, just in general, but you don't need them for this chapter. Okay, and I think that is it. So I can begin going through the exercise set. So here we are at the exercise set. Now, we're familiar with the statement of cash flows already. It's come up in previous chapters. Obviously, we're going to go into more depth in this chapter. Just as a reminder, the reason we need a statement of cash flows is because most companies use the accrual method of accounting, which means that we count a sale when we provide the product or service, regardless of whether or not we have received the money from the customer. And we count an expense when we incur the expense, regardless of whether or not we've actually paid it. So if we look on our income statement, it tells us our revenue and expenses, our profit and our losses, but it doesn't tell us cash flow, right? So looking at the cash flow statement, we can actually see how much actual cash came in, how much cash went out. And that is very important because a company could have a profit on their income statement, but be broke, where they have no cash. That would not be good, right? There could also be a situation where a company looks like it has a loss according to its income statement, but they've got plenty of money in the bank. So we need both the income statement and the cash flow statement to really understand what's happening with the company's profits or losses and with the company's cash flow. So most of what we'll be going through here is how to prepare the statement of cash flows, including how to do those indirect and direct methods for the operating section. Okay, that's what's going to take most of this chapter. Our first exercise here says to provide some journal entries for some transactions. And we're going to identify with each of these, is this a source of cash, meaning the company received cash? Is it a use of cash, or is it neither? And then we're going to journalize the transaction. Okay, the first one says we declared and paid to shareholders a dividend of $24,000. So that would be a use of cash, right? Because we paid out money. Anytime money's going out, we're using cash. If the cash is coming in, then it's a source, right? It's a source of cash coming in. So use of cash, I'll give that a letter U. And the way we journalize it, well, this would be a shorthand version. As you might recall, when you declare dividends, you debit retained earnings, credit cash dividends payable. And then when you pay it, you would debit cash dividends payable and credit cash. That's how you would normally do it. It would be two separate journal entries on two separate days. For some reason here, the company is just declaring dividends and paying them at the same time. So that doesn't usually happen, but if it happened that way, then we could just debit dividends and credit cash. Okay, so that's all we would do for our journal entry. And then of course that would impact the cash flow statement, specifically the financing section, because cash went out in relation to stock, right? Because we pay the dividends to the stockholders, so it's part of financing. Okay. Second transaction. We issued some common stock at par value, so we don't have to worry about additional paid-in capital. And it was for $12,000 in cash. Okay, well, that is a source of cash, right? We issued stock and we received cash. So we would debit $12,000 to cash and credit common stock. So basically, anytime cash is a use, it's going to be credited. And when it is a source of cash, then it will be debited. Okay. Next, we sold some land. The land cost $10,000. So we have to clear that off of our books. So we're going to credit that asset to get it off of our books. And we sold it for $16,000. So that is how much cash we received. Now you'll notice that our debits and credits don't match up, right? Because we sold the land for more than what our books said it was worth. That difference is considered a gain. So we have to put a $6,000 gain, and now our debits equal our credits. Oh, and I forgot to mention, this is a source of cash. All right, moving on to D, we bought a truck with a note payable. Aha, we got a truck. We signed a note saying that we're going to pay for this truck later. There was no cash in this transaction. So this is going to be N for neither. We would journalize it. I think it was $38,000, right? Yeah, 38,000. So it's a debit to our truck account because that's what we got. Credit to notes payable because that liability has gone up. But again, there was no cash in this transaction. And the last one, we collected $8,000 from accounts receivable. That is a source of cash. So we debit cash for the 8,000 and accounts receivable goes down since those customers don't owe us that money any longer. All right, that is exercise 1. Let's move on to exercise 2. My voice is kind of shot today. I apologize. It's the end of the semester, so maybe that has something to do with it. Okay, here we're going to try to figure out which section of the statement of cash flows each of these transactions would impact. Now, the first one is actually a bit tricky. We paid an advertising expense. That is part of our operations because, as I mentioned, operations is anything to do with making or selling our product or service, including just general running of the business. That would be part of operations as well. And so advertising would fit into that. Sorry, I've got something. Right before we started, I drank a smoothie and there's something like itching my throat. So anyways, back to what we were talking about. So advertising would be an operating expense, but advertising can also be considered an investing expense. And I think the reason for that, I can't tell you 100% for sure, but the best I've been able to find out is sometimes when you advertise, you're not trying to increase your immediate sales, believe it or not. Sometimes advertisements are really designed to just create brand awareness that maybe will lead to more sales a year or two down the road. For example, if a company does some sort of commercial where they don't even mention any of their products, they just focus on the brand and just trying to, raise people's awareness of the brand, that might cause a few people to go out and buy the product, but overall it has a cumulative effect that, again, maybe next year when that customer goes and makes a purchase, at that time, they're influenced by that advertisement they saw a year ago. That's the best thing I can explain as why advertising would sometimes be considered more of an investment instead of an operating cost. If anybody comes up with a better answer than me, let me know. But the official answer here for this question is that advertising can be both an operating and, in some cases, an investing expense. So the cash flow would fall under operating or investing, or both. The other three are a little more straightforward. Paying dividends to shareholders, that is part of financing because, again, issuing stock is part of financing. So paying dividends to those stockholders is also part of financing. Purchasing business equipment. Okay, well, that is an investment in our own company. So that is an investing activity. If we were purchasing supplies, raw materials, things like that that are going to get used up quickly, that would be part of operating. But equipment is a long-term investment, and that's part of investing. Sold merchandise to customers. Okay, the cash that generates is part of operating. Okay, because it comes from selling our products. So we can move on to exercise 3. And let's see, again, in which section of the statement of cash flows would these transactions be included? All right, we borrowed money from the bank for a business loan. That is going to be financing. We declared dividends to be paid next year. So if we paid the dividends, it would be financing, but we haven't paid them yet, so there is no cash flow. So this is actually none. We bought treasury stock, okay? Well, remember, stock is part of financing. So if we buy that stock back, that is also considered financing. We bought a 2-year insurance policy. That's another rare event. Usually insurance is purchased for a year at a time for commercial insurance. Even if you bought a 2-year policy, though, it's still considered part of your operating cash flow. So we'll give that an O for operating. And then again, buying plant assets, that is an investment in the company. So that is an I for investing. Okay. Now we get to the indirect method that I told you about. Again, this term only applies for the operating section of the statement of cash flows. And the reason it's called the indirect method is because to calculate cash flow using this method, we don't actually look at how much cash came in and how much cash went out. If we did that, that would be a direct calculation. In the indirect method, instead, what we do is we start with our net income from the income statement, which again, you know, is not cash flow. So we start with that net income, and then we make adjustments to it to figure out what our cash from operating is. So the first thing we need is net income, and that's given to us right here, $325,000. The next thing we need to do is we need to add back depreciation. So let me explain this. Depreciation expense is part of the income statement, right? The income statement is revenues minus expenses equals our income or loss. And depreciation expense is an expense, so it would show up on the income statement. However, there is no cash associated with that depreciation expense. It's just an accounting entry without any cash being involved. So we need to reverse it. And the way we do that is we add that amount back in. So it says here that there was $26,200 of depreciation that year. So we need to add back $26,200 of cash to correct that depreciation, right? Because we're trying to get from our net income to our operating cash flow. Now, it also says that we sold a company truck and we lost $7,800 on that transaction. Now, that loss also would have shown up on the income statement and it would have reduced our profits. But selling a company asset like that is actually an investing activity. Just like buying a truck would be investing cash flow because we're investing in this vehicle for our company. Selling a truck that we own would also be investing cash flow, although in this case, the money's coming in because we sold the truck. But regardless, it has to do with an asset that we had invested in and we're now selling. So we need to get it out of the operating cash flow. So even though it was on the income statement, we don't want it in our operating cash flow. So we need to reverse this transaction as well. So we're going to add back the $7,800. Okay. So to get our operating cash flow, again, we're starting with our net income, adding cash to offset the depreciation expense, adding cash to offset the loss on the sale of the truck. We are going to show the income from that, the cash from that sale in the investing section, but right now we're working on the operating section. So we offset it by adding back the cash, and then that's going to give us our net cash flow. So again, we take our net income plus the depreciation plus the loss on the sale of the truck. And that means our cash flow from operating activities was $359,000, assuming that these are the only adjustments that we had to make. Okay, so this is how the indirect method works. It is complex, right? We're starting with net income, we're making all these adjustments, and then we're arriving at our operating income. And the reason that, I'm sorry, operating cash flow. The reason that this method is used is it's actually easier for accountants because they can just, once they're used to it, they know how to just take the net income, make these adjustments, and boom, there's their cash flow. You'll see that when we get into the direct method, it's also not super hard, but you have to use all these different formulas. Well, not really. There are basically two different formulas that we use in the direct method. And it might be more work in real life to go get the data that you need for that method. So the indirect method, although it's more complicated to learn, it can be easier in practice. but we're going to learn both methods. I see that Jane has joined us. Welcome, Jane, and great job on your course project. By the way, I did get those graded on Monday. We are now going to exercise number 5 here in the exercise set. So then this is also related to the indirect method of the operating section of the statement of cash flows. And in this case, what we see is some of our assets have changed, and that is very normal, that from the beginning of the year to the end of the year, some assets will go up, some will go down. And using the indirect method, we need to adjust for that as well. For example, it shows that our accounts receivable, well, actually, let's start with prepaid insurance. Let me think. Is that going to be clear? Which is going to be a better example? Okay, we'll start with accounts receivable. Accounts receivable went from $20,000 at the beginning of the year to $25,000 at the end of the year. And what that means is that the amount our customers owed us at the beginning of the year was only $20,000. At the end of the year, our customers owed us $25,000. So that went up by $5,000. And that's cash we have not received from our customers, right? It's money that they owe us. And so we have to then reflect that cash has gone down by $5,000. So when an asset goes up, cash goes the opposite direction when we're doing this in, indirect method. Don't overthink it because it gets very confusing. If you think about it too much, just remember if an asset goes up, cash goes down. If an asset goes down, cash goes up. So it's actually just like we had the loss on the sale of the truck in the last exercise, right? A loss is profits going down and cash went up. If we had a gain on the sale of an asset, well, that gain means profits are going up from selling that asset, so cash goes down. So when it comes to changes in assets, for cash flow purposes, we do the opposite. So the impact of accounts receivable going up $5,000 is cash flow is going to go down $5,000. Now that is not our answer yet because we have a second part. We have prepaid insurance going down. We went from having $12,000 of prepaid insurance at the beginning of the year to only $9,000. That means that we used some prepaid insurance, but following our principle, if an asset goes down, cash goes up when we're doing this indirect method, okay? So we have cash going down 5,000 because accounts receivable went up. We have cash going up 3,000 because prepaid insurance went down. So we combine those two and it comes out to negative $2,000. Okay. And so that is our answer. The impact of these changes in our assets decreased our cash by $2,000 using the indirect method. So that's all we need for exercise 5. Let's move on to 6 here. All right. Again, we're doing the indirect method, and we are told that the net income is $122,000. So we're going to start with that figure from the income statement. Now here we're told that accounts receivable went down. Okay, that's an asset going down. How much did it go down? Well, if we look from 2017, it went from 15,000 to by the end of 2018, sorry, it went down to 12,800, right? So it went down $2,200. This window keeps getting in my way. I don't know how to get rid of that. Right, but you can see it went down from 15,000 to 12,800. That's $2,200 that asset went down. So we need to increase cash 2,200, right? I'll just put a plus sign so you can see that. Cash goes up. Then we had another asset go up, prepaid insurance. It went up from 3,500 to 4,000. So it went up 500. So cash goes down 500. Then we get to liabilities. Now, liabilities are a little easier because cash moves in the same direction. So we have accounts payable going up by $800. So guess what? Cash goes up by $800. And here we have accrued liabilities, things like salaries payable, for example, went down 300. So cash goes down 300. Okay. So just remember, cash moves the same way as liabilities, but with changes in assets, it moves the opposite direction. Okay, now we can calculate and see what is our operating cash flow. We take our net income, add that decrease in accounts receivable, subtract the increase in accounts payable, in prepaid insurance, sorry, add the increase in accounts payable, subtract the decrease in accrued liabilities. And if I did that right, we get 124,200. Let's double check my math. Okay, I think I was right the first time. Let's triple check. Net income plus 2,200 minus 500 plus 800 minus 300. Yes. And to be extra sure, just go down to our exercise and yes, 124,200. Okay. That's why you always double check your calculations. So again, we started with net income from the income statement. We made our adjustments and we got our operating cash flow. Okay. By the way, if we used the direct method, which we will learn later on, we would have gotten to the same answer. We would have just gotten there in a different way. All right, number 7 is similar. We are using the indirect method, so we're going to start with our net income. We're going to add back our depreciation. So you always, with depreciation, add it. Then accounts receivable is going down. That means cash goes up. That's $2,000. We have another asset here. Merchandise inventory is going up, which means cash goes down. Then we have salaries payable going up, so cash goes up, right? And then we can get our total net income plus depreciation plus accounts receivable minus the merchandise inventory and plus salaries payable, and we get 19,350. And that sounds right to me. There we go. Okay, so that's how you do the indirect method. If you just follow those steps, it's not that hard. If you try to think about why are we doing it this way, you might just get confused. So try to avoid overthinking. Okay, then we can go on to exercise 8. Another indirect method. Okay, we're starting again with net income, adding back depreciation. We had the loss on the sale of an asset. So again, we have to do the opposite. Since there was a loss, we have to add cash. Accounts receivable went down. So again, we do the opposite. Cash goes up. Then we get to a liability, and remember, cash moves in the same direction as liabilities. So if that liability went down, cash goes down. And that makes sense, because if your debt goes down, well, you must have paid it off. And how would you do that? You would use cash, right? So it makes sense that when a liability goes down, cash goes down. So now let's do our calculation and see what we get. I got 166,750 as our cash flow from operations, and that is correct. So let's move on to number 9. All right, so now we're going to move on. We've been doing the operating section using the indirect method, right? Now we're going to do the financing section. Again, the financing and investing sections are more straightforward. You're just basically reporting any cash that came in and any cash that came out. None of this reversing anything. None of this indirect method for these sections. So here we have 3 transactions. The first one says we acquired new plant assets. Well, that is an investing activity, right? Because if we buy equipment for our factory, which is what a plant is, a factory, if we buy assets for the plant, especially long-term assets like equipment, that's an investing activity. So it's actually not a financing activity, and it does not even apply for this exercise. So they just threw that in there to throw us off. We're going to ignore that. But here it says we borrowed from a bank a note payable of $40,000. So we borrowed $40,000 of cash from a bank. That is a financing activity. So that is $40,000 that came in from the bank because we borrowed it. We also declared and paid dividends to shareholders. So paying those dividends is $15,000 going out. That again is a financing activity, right? Because it has to do with stock. So we had 40,000 coming in from the bank loan, going out from the dividends. The net impact is $25,000 of positive cash flow from financing activities. Okay. So that wasn't so bad, right? The tricky part about the investing and financing sections is just remembering what's considered investing and what's financing. Here's one where we're going to do investing. So again, acquiring new plant assets is an investing activity. So it doesn't say here that we paid cash for it, but we can make that assumption. And because it would have told us if it wasn't cash. So under plant assets, we're right down here. It does say cash paid for plant assets, 18,000. And that's money going out the door. So I'm going to put a minus sign. Now it says collected interest on investment assets. Well, okay. If we invested in things like equipment for our own company, that is considered an investment, but that would not generate any interest, right? Investments that generate interest would be if you bought bonds or stocks in some other company, and then you earned, well, interest would be from bonds specifically. Or even if we made a loan to somebody and then they were paying us back with interest, that would also be interest from an investment, right? We made a loan, but we're getting that money back with interest. So that's actually considered an investment. In either case, though, whether we bought bonds or we made a loan, either way, that interest that we collect, guess what? It's not considered investing cash flow. This, I don't even understand why, except that we get that interest probably monthly or quarterly. And so it's something we get throughout the year. And so I guess it just applies under operating for that reason. I don't know. But for some reason, the interest on investments is considered operating cash flow. So we're not going to include it in our investing cash flow. Okay. So that's one of those things you just kind of have to remember. So the interest on our investment assets belongs under operating cash flow, not investing cash flow, which is what we're working on. Here we sold some land that we used in our business. Whether we used it or not, it's an asset that we had purchased, that either we were investing in our own company or maybe we just bought it for the purpose of reselling it. Either way, it's considered an investment. So we sold this land. The cash that came from that sale is cash flow from investing. Okay. So in this case, we had 36,500 coming in from the sale of land, 18,000 going out from buying plant assets. So the net cash flow from investing activities is 18,500. All right. Let's move on. Jane, if you have questions at any point, please do let me know. And moving on to 11. So here we are doing an operating section using the indirect method, and we are doing an investing section. Okay. So again, for operating, we start with net income. Then we have to make our adjustments. In this case, there's only one. We have to adjust for the gain on the sale of land. So remember, if we have a gain on the sale of an asset, we have to subtract cash. If we have a loss on the sale of an asset, we have to add cash. So since we have a gain, we need to subtract. But how much do we subtract? Well, if we look at the data here, we see that the land originally cost us $25,000. So that would be the book value. As a reminder, land does not depreciate. If it were a building, you'd have to take the original cost minus the accumulated depreciation to get the book value. But for land, there is no depreciation. So the original cost is the book value. So we see it originally cost $25,000. We sold it for $35,000. So we made a gain of $10,000. That gain of $10,000 would be on the income statement, but it's not operating cash flow, it's investing cash flows. So to get it out of the operating section, we need to subtract that $10,000 gain, bringing us to $148,750 as our operating cash flow. Then we move on to the investing section. Well, we did sell the land for $35,000, right? It was a $10,000 gain, but the cash we received from selling it was $35,000. So that is the cash that goes in the investing section, because that is the actual cash we got from selling the asset. Long story short, we had to take the gain out of the operating section, but we report the full cash we received in the investing section. from that sale of land. Then we spent $40,000 buying plant assets. So that's $40,000 of cash going out. So the investing section has negative cash flow of 5,000, right? 35,000 coming in, 40,000 going out is negative 5,000 for investing activities, right? And that doesn't mean that we had negative cash, right? Because it's all the cash is in the same bank account, especially for a small company. Maybe bigger companies have multiple, but just to keep it simple, it's all the same cash account. And all this, like in our accounting records in the ledger, it's all in the same cash account. In our bank account, it's all in the same checking account, right? Our cash account in the ledger really reflects our bank account in the bank. And that is why, if you remember, we had to do bank reconciliations in one chapter so we could compare and make sure that our cash matched our actual checking statement, bank statement. So we have more cash coming in this example from operating compared to what went out. But in the investing part of our cash flow statement, we had more going out than what came in. Okay. However, on the actual statement of cash flows, we're going to add the operating cash flow, the investing cash flow, and the financing cash flow all together to get our total cash flow. And that's going to show us for that period of time how much cash either went up or went down. Okay. Let's just say, for example, the operating section showed cash went up by $100,000. And the investing section said cash went up by 20,000. And then the financing section said cash went down by 70,000. So we have 100 plus 20 minus 70. That would give us a net cash flow for the year of $50,000, which means that in total, we had $50,000 more cash come in than what went out. Okay, so when we add the three sections of the cash flow statement together, we get our total cash flow, which equals the change in the cash account from the beginning of the year to the end of the year. So in that scenario where our total cash flow was $50,000 for the year, if we looked at our cash account at the beginning of the year and then looked at the end of the year, we would see it went up by $50,000. All right, so the cash account, which shows up on the balance sheet, correlates to the change in cash that we're going to see on the cash flow statement. So hopefully that makes sense. Okay, with 12 and 13, we need to do a little solving for X, kind of like we did back in week 1. In fact, this ties in directly with what I was just telling you about. So with number 12, we're missing a piece of information. We know the cash flow from operating and the cash from investing. What we don't know is the cash flow from the financing activities, which would be the third area, the third section of the cash flow statement. However, as I just told you, if we add up these three sections, that's going to equal the change in cash from the beginning of the year to the end of the year. And we see that the cash from the beginning to the end of the year went up by 7,500. So the way we can solve this and find this missing number, let's just make a little space here. We can say that our operating cash flow, and then we had negative investing cash flow, and then whatever our financing cash flow is, I'm just going to call it X because we don't know. that those three combined equal the difference between beginning and ending cash flow. So I could write it like this. Okay. And if it's helpful, we could also say this. We could say operating cash flow plus our investing cash flow, which was negative, plus whatever our financing cash flow is, equals the difference in cash from the beginning to the end of the year, or another way to say it is the ending cash minus the beginning cash, which we could simplify to 7,500, right? And we could also simplify this by taking out this plus, because if you add a negative number, it's the same thing as subtracting a positive number. So I can just go like that, and it works out the same. So we're saying 60,000 minus 28,500 plus whatever financing cash flow is equals our change in cash of 7,500. Now we can solve it. Again, we can subtract 60,000 from the left side, but we have to then subtract 60,000 from the right. We can add 28,500 to the left to clear it off, but we have to then add 28,500 to the right. And now we can calculate this, and we'll find out what X is. So we have 7,500 minus 60,000 plus 28,500, and we get negative $24,000. So that is our cash flow from financing. We can check that if we take our operating cash flow, minus the 28,500 of investing, minus the 24,000 of financing. We get our $7,500, which if we add that to our beginning cash flow, or beginning cash, equals our ending cash. So we see it works. We did come up with the right answer. And so now we're going to do something similar here for 13. Okay, this time we don't know the operating activity. So it's going to be X plus the 8,900 from investing minus the 25,000 from financing that went out equals ending cash flow minus beginning. Ending cash minus beginning. Okay. That will tell us our change in cash. So now in this case, when we take our ending cash minus our beginning cash, we see it's negative. That means our cash went down $1,900 during the year. But that's okay. It is what it is. So our formula here is going to have to equal negative 1,900. So again, what do we do here? If we want to get rid of this 8,900, we subtract it from the left side, which means we have to subtract it from the right side. We can add 25,000 to the left. So we have to add 25,000 to the right. Then we are going to take our negative 1,900 minus 8,900 plus 25,000, and we get 14,200. So that is our missing number here. Oops. I don't know what I'm doing. Okay. There we go. Okay. Let's check. So if we want to check and make sure this all works out correctly, we could take our operating cash flow plus investing minus the 25,000 that went out for financing. That gives us negative $1,900, which if we then add that to our beginning cash, we do get our ending cash. So that is the right number. We have confirmed it. And we're done with number 13. Okay. All right. Next, we're going to work on a ratio. This is actually pretty easy. So this is a ratio called free cash flows. And there are a couple different versions. So we've got first the free cash flow. Oh, actually, okay. In this exercise, we're just going to figure out free cash flows. So this is an amount that tells us how much cash we have that's free to work with. What we do is we start with our operating cash flow, which we see here is 135,000. We do not need investing or financing cash for this information, so we're just going to ignore these numbers. But what we do need is our cash that we're going to use for capital expenditures, because if we're planning to make some big purchases like equipment, well, then that cash that we need for that is not going to be free, right? So we're going to subtract that $75,000. And any cash that we're paying out in dividends is also no longer going to be free for us to use. So we're going to subtract that as well. Okay, so if we take the cash from operating activities, in other words, the total change in cash from everything related to our operations, minus any cash we're going to use for capital expenditures or dividends, what's left over is our free cash flow. That is the money that we are free to work with or whatever else we might need. So when I do the math here, we come up with $45,000. Okay. Operating cash flow minus capital expenditures and dividends gives us 45,000. Okay. Here's another similar exercise. In this one, we have to do a little bit more calculating, and we're doing 2 different years. So our cash flow from operations is 222,000 in 2018, 200,000 in 2017. Now, again, we don't need to know the investing cash flow, but they did tell us the capital expenditures for each year equal 50% of the investing activities. So in this case, we do need to use this number to figure out our capital expenditures. So 50% of 33,000 is 16,500, right? Is that right? Yeah. Okay. And yeah, that's right. And then 50% of 35,000 is 17,500, right? So we just had to take half of this to be this. And then they tell us the dividends are 15,000 each year. So we're going to put that in as well. Okay, so we're going to take cash from operating, subtract capital expenditures and dividends. So we end up with $190,500 of free cash flow for 2018. And for 2017, we get 167,500. Okay. Let's double check these numbers, but they look good to me. 190, 167. Okay, those look good. And now we can go on to exercise 16. So this one starts with calculating free cash flow, but then we're going to see 2 ratios that we will calculate using free cash flows. Okay, So first, we have to calculate the free cash flow, operating activities, minus capital expenditures and dividends. So our free cash flow is 57,500. Then to get our cash flows to sales ratio, we take our free cash flow, divide it by our sales revenue, which is right here. And we'll round that off to 26%. To get free cash flows to assets ratio, again, we're going to start with our free cash flows. And you guessed it, we'll divide it by assets. Our total assets are 302,500. That gives us 19%. Okay, so our answers here are 26% and 19%. Oh, just a reminder, by the way, well, two reminders. When you're entering a percentage in Canvas, you need to enter it in this format. So don't put just 26. If the question is, what is the cash flow to sales ratio? If you put 26, Canvas is going to mark it wrong. If you put 0.26 to indicate that it's 26%, then Canvas will recognize it as correct. Okay, so percentages, you always have to enter using a decimal point. And then also remember that if the answer is negative, you have to pay close attention to how the question was worded. Because if the question, for example, says, how much was the loss? Well, the loss already implies it's a negative number, so you would just enter the number without the minus sign. On the other hand, if the question asks, what is the net income? And the net income is a negative number, then you would have to enter it as a negative number. So you'd have to put the minus sign and then the number, okay? So keep that in mind in Canvas. Okay, two more exercises and we'll move on to the problem set. Oh, now we are up to the direct method of the operating section of the statement of cash flows. So far, we're focusing on the indirect method, right? So now we'll do the operating section using the direct method. Okay, you'll notice this is very different. What we do, instead of starting with net income, we're actually going to calculate how much cash was collected from our customers. So how much cash came in. So we're directly calculating cash that came in. And one way to do that, instead of actually adding up all of the cash that came in from customers, we can instead take our beginning accounts receivable, which is 105,000, add our sales, which is 700,000. And that means we could have potentially collected $805,000 from our customers between what they owed us at the beginning of the period and the additional sales. But at the end of the period, there was still $85,000 that had not been collected. So that is our ending accounts receivable. We're going to subtract that, and we'll find that that leaves us with $720,000 of cash that must have been collected, right? So basically what we're doing here is we're adding the sales, subtracting the ending accounts receivable. And that tells us how much cash was collected from our customers for the operating section. But we also have costs for operations. So we have cash flow going out for operations. And that's what we're going to look at in the next section, some of those outgoing cash flows. A lot of that is going to go towards inventory. But the thing with inventory, to figure out the cash flow using the direct method, you first have to figure out how much inventory you purchased, and then you can figure out how much you paid for that inventory that you purchased. So it's a two-step process. The second step follows a formula that's similar to what we just used here. You've got a beginning plus something and then minus an ending. And you'll see we get to something like that here. We've got step 2 is beginning accounts payable plus purchases minus ending accounts payable. But the first step is a different formula. In the first step, we're starting with ending inventory, because what we're doing here is we're trying to figure out how much inventory we purchased first, so that then we can figure out how much we paid for the inventory that we purchased in step 2. So for step 1, we start with our ending inventory. We see that that was $74,000. We have to add our cost of goods sold, and that gives our total goods available for sale. Then we subtract our, we subtract our beginning inventory, and that gives us the inventory that we purchased. Okay, so now we know how much inventory we purchased. That's step 1. That inventory that we purchased is listed here as purchases. Okay, slightly different wording, but same idea. So I just copied this number down to here. Now what we're going to do is beginning accounts payable is $58,000. So at the beginning of the period, we owed $58,000 for inventory. Then we bought another $512,000. So that's a total of $570,000 we could potentially owe for inventory if we have not already paid for any of it. And then at the end of the year, our accounts payable went down to $55,000. So we only owed $55,000 at the end of the year. So that means we must have paid the difference. Okay, so beginning accounts payable plus purchases minus ending accounts payable is cash paid for inventory. That's how you do the direct method. Okay, you're going to need these formulas. In both cases, you are adding here and subtracting here. What's different between these formulas is in step 1, you're starting with ending and subtracting beginning. In step 2, you're starting with beginning, subtracting ending. Okay. So it gets a little confusing, but you could always refer back if you have questions, or you can reach out to me. So that is it for the exercise set. If there are no questions, we'll move on to the problem set. And we've got 5 problems to work on together. Okay, starting with problem number 1. So on this one, again, we're going to decide if each transaction is a source of cash, use of cash, or neither, and which section of the statement of cash flows it's going to influence, and we're going to journalize. Okay. First transaction, we paid $12,000 of accounts payable. Okay, well, that is a, that would impact the operating section, because accounts payable is money we owe to our suppliers. So that's part of our normal operations. It is a use of cash. And the journal entry would be $12,000 debit to accounts payable because it's going down, and credit to cash because it is going down. B would be collected 6,000 from a customer, and this is from a long-term note receivable. Okay, so if we collected money from a customer, that is a source of cash. I'm sorry, that goes in the next line. It would impact, okay, let me think. If it's a note receivable, that means we made a loan to our customer for some reason, or it could be that what's more likely is they bought inventory from us, but signed a note in exchange. So they didn't pay us at the time, but we wanted to charge them interest and get in writing that they're going to repay this note. So it's not an accounts receivable, which would have been less formal. Instead, it's a note receivable. Okay. So for whatever reason, the customer owes us $6,000 and they've now paid us $6,000, right? So that is an investing activity because by making that loan to the customer, we earned interest and it's an investment. And again, that is a source of cash. Okay. And the journal entry will be $6,000 debit to cash. And when they paid it down, they decreased the note receivable. So that would be a credit to notes receivable. C, we issued some common stock at par for cash. Okay, let's think. That's a financing activity. It is a source of cash. Financing, source, and it was $24,000. So we got $24,000 in cash and we issued $24,000 in stock. Again, it was at par value. So there's no additional paid in capital. D says we paid $6,000 in dividends to shareholders. Okay, so that's a financing activity. It is a use of cash. And it would be $6,000. So again, in this case, they did a simplified version. We're just debiting dividends, crediting cash. E, we sold some products to customers on credit for $15,000, okay? Well, if we sold products on credit, there is no cash in that transaction. So I'm going to put no impact on the cash flow statement. I don't think we would even want to put a note in that case because it's just from our normal operations. If it were a major purchase that did not involve cash, we would probably include it as a note on the cash flow statement. But just collecting, what was it, collecting money from customers, I would not even include that on the cash flow statement. And so it's not applicable. I'm putting an N there. However, we do need to journalize it. So that was $15,000. Accounts receivable went down and sales went up. I'm sorry. Oh, okay. I guess sales did go up because we just did these sales this month. Okay, right. Correct. And the last one, we paid the current month's utility bill, $1,500. Okay, well, that requires cash. This would be the operating section of the statement of cash flows. It would be a use of cash, and I think it was $1,500. It's an expense, and it's a use of cash. Okay. So just to double check the letters, we have OUIS. Oh, problem set. Okay. OU, ISFSFU. I didn't mean that like it sounded, FSFU. Then we have NNOU. NNOU, NNOU. Okay, everything looks good. So we're done with number 1. And next is 7, followed by 8. Okay, problem number 7. So we have 2 land transactions. We have a purchase of land for cash and a purchase of land with a note payable. So how would these transactions be reported? So number 1, it would be journalized. And number 2 would be a note on the statement of cash flows. Because the second purchase here did not involve any cash. We got land, we signed a note, and there was no cash. So we would just note it on the cash flow statement, but not include it in the actual calculations of cash flow, because there was no cash flow, right, in this purchase. So what section of the statement of cash flow for number 1? Number 1 was we bought land for cash. That would be the investing section. And 2 is not applicable because there was no cash flow. I guess if we wanted to put it as a note, which I mean we should do, we can include that probably, I would say, in the investing section since we're buying land. Or note in investing section. So I'll check and see what the official answer is on that one, but we could do it either way. And then does each transaction represent a cash source, use, or non-cash? So number 1 was a use of cash, and number 2 was non-cash, right? The second land purchase was non-cash. Okay, let's check these answers. So that's problem 7. Problem 7. Oh, yeah. There we go. Okay, problem 7. So let's see. They say purchase of land this year for cash goes on the statement of cash flows in the investing section, activity, use of cash. So journalized in the investing section, it's a use of cash. So that's exactly what we said. And for the second transaction, note payable, so it's only a notation, and it would be noted in the financial statements, but it doesn't say to put it in any particular section. And it is a non-cash transaction, okay? So that is what we said. We said we would note that on the statement of cash flows. So as far as what section, that's not applicable. If you needed to put it in a particular section, it would be the investing section. But the point is just that it's a note on the statement of cash flows, and then it is a non-cash transaction. Okay. So that is number 7. Next, we will do 8. We are using the indirect method here. to make a statement of cash flows. Okay. So here we go. Using the indirect method, we always start with net income. All right, so that's going to go right here. Then we have to add back our depreciation. We see depreciation here is 4,000. Accounts receivable. Let's see how it changed. Accounts receivable went down by $900. So that means cash has to go up by 900. Let's look at merchandise inventory. Merchandise inventory went up by 9,000. That means cash has to go down by 9,000. And then accounts payable changed as well. Accounts payable went down by 2,500. So oh, I have to scroll down. Oh, there we go. I was kind of lost there for a moment. I found it. Okay. So those are the adjustments. So let's go ahead and subtotal all of these. We have the $4,000 depreciation plus $900 for an asset going down, minus 9,000 for assets that went up, and then minus 2,500 for a liability that went down. That gets us a net impact of minus 6,600. We'll subtract that from our net income. That leaves us with cash flow from operating $21,800. Then cash from financing. So let's take a look here. We did take out a $30,000 note. So that's a financing activity. We see that our notes went up $30,000, which is the exact same thing. And we also paid down note payments by 14,500. Okay. So we have cash coming in. Let's think about this. Plant assets were purchased, financed by a note. So kind of depends on how this transaction happened. If we got the cash, and that's cash that came in, and then we paid it for the plant assets, then that's also cash going out, right? So even if we borrowed that cash from the bank, it's going back out for the purchase. If we didn't borrow it from the bank, if the bank is directly giving it to the company that we're buying the assets from, then it doesn't count as cash flow. So in scenario one, we have cash coming in and going back out, which washes itself out. On the other hand, if the cash goes directly from the bank to the other party, we also don't include it. So either way, that $30,000 is not going to show up on the financing cash flow. However, we did pay down notes payable by 14,500. That would involve cash flow. And so this is going to be negative 14,500. That's our cash flow from financing activities. All right. I don't remember that being the number, so I'm going to double check, but I think that's, I mean, I don't see why that wouldn't be right. So we are on number 8. Yeah, no. Where is it? Am I on the right one here? Oh, that's number 9. No wonder. Okay, so minus 14,500 is correct. Okay. And so now we had 21,800 positive cash flow from operating, 14,500 negative from financing. We did not have any investing cash flow in this scenario. So let's just total them up. That's a total cash flow of 7,300, right? If I add operating plus investing, I'm sorry, operating plus financing cash flow, we get $7,300, which if we add to our beginning balance of 85,000 should get us to our ending balance of 92,300. I went too far again. There it is. Okay, so let's check. 7,300, that is our change in cash flow, plus our beginning cash equals our ending cash. So good, that works. And then we did exchange a note for plant assets. The amount of that, it says, is $30,000, right? So again, that was not included in our calculations. It's just listed here as a note. So there we go. We finished number 8. We've got 2 problems left, 11 and 13. Okay, we can see that that is correct. Number 11. Here we go. We're going to make a statement of cash flows using the indirect method. Okay. Indirect method. So we start with net income. Make adjustments. We have to add back depreciation. Accounts receivable went down by 8,300, so cash goes up by 8,300. Yeah, that's right. Inventory change went up by 4,900, cash goes down. Prepaid assets went up, so again, cash goes down. Accounts payable went up, so cash goes up. And then let's subtotal these adjustments. So I came up with 11,450. Add that to our net income. And I get 47,950 as the cash flow from operating. Let's take a look at that. Okay, 47,950 is correct. Then cash flow from investing activities. Okay, so we look up here. What this says is our investments went up by $10,000. What that tells us is if our investments went up, well, our investments could go up through appreciation, but we would only, let me think. Yeah, we would only calculate that gain when we sold the assets. And here it says we didn't sell any assets. So this is not a change in investment value based on appreciation. So it must be that we bought more investments. And if we bought $10,000 of investments, then cash went down by $10,000, right? So that's what we're going to see here, negative 10,000. And since that's the only transaction related to investing activities, we have negative $10,000 from investing cash flow. And then we have financing. All right, financing. We did issue another $20,000 to common stock. So that's going to generate $20,000 in cash. We paid down some notes payable. We paid them down $9,400, so that decreases cash. We can subtotal those two. And we get 10,600. Okay. So let's add them together. We have operating, investing, and financing. And that comes to 48,550 change in cash flow. Our beginning balance was 18,444. So if we take that, add it to 18,444, we end up with cash of 66,994. Let's double check that. $66,994. Very good. Okay, that was a little time consuming, but that was a full statement of cash flows. And again, you got to see how the net income plus adjustments using the indirect method leads to our cash flow from operating. Then if we add that to the financing and investing cash flows, we get our total cash flow, which if we then add that to our beginning cash equals our ending cash. So it all fits together perfectly. Let's see our last problem here, last problem of the whole semester, actually. I know it's sad. I know, heartbreaking. Problem 13. Let's see. Okay, problem 13. What are we doing here? We're using the direct method, okay, for the operating section. And we see that this is sort of a long problem here. We can handle it though. We got this. All right. Using the direct method, remember we have, we have these formulas, but we're actually making the statement of cash flows. So what we're going to do, this is only the operating section. We're going to start with figuring out how much cash came in from our customers and then how much cash went out. The cash going out, some of it is going to suppliers of inventory, some of it's going to other places that we owed money to. And then, so if we take the cash that came in minus the cash that went out, then we're going to have our net cash flow from operating activities. And again, if we use the indirect method, we would come up with the same answer as the direct method. But in this case, we're doing direct. So to find this out, we need to use some formulas, and what's down below here are the formulas. So the first formula we're going to use here is the one to figure out how much cash we got from customers. Then we've got our two-part formula to figure out how much inventory we purchased and then how much cash we paid for that inventory. Then we've got one final formula here to figure out how much cash we paid for other expenses besides inventory. Okay. So that's what we're doing here. So to get cash collected from customers, we don't know that yet, so we need to use this formula. So we need to start here, beginning accounts receivable. Beginning accounts receivable is 43,400. And then we can see our ending accounts receivable is 45,300. So I'm going to put beginning here. I'm going to put ending here. And we also need to know our sales. Accrual basis sales is sales. Okay, 299,000. Okay, so then we're going to add here beginning accounts receivable plus our sales equals 342,400. And then we're going to subtract our ending accounts receivable, and that will tell us how much cash we collected from our customers. Okay, I'm going to double check it here on the calculator. Beginning accounts receivable, so how much our customers owed us at the beginning, plus everything else we sold, that gives us a total amount we could collect of 342,400. At the end of the period, we had not collected 45,300, so the rest is the cash that we did collect, so 297,100. That number goes up here. That is our cash collected from customers. So that's the cash that came in from operations. Now the cash that went out, first for inventory. So here we're going to start with our ending inventory. We also need beginning inventory. So ending inventory is 1,600. Beginning was 1,800. We also need cost of goods sold. Let's get that. Cost of goods sold is up here, and that is 135,000. It's too far. Okay, so if we had at the end of the period $1,600 worth of inventory, plus we sold inventory that cost us 135,000, our total cost for all of the inventory available was 136,600. Now, at the beginning of the period, we had $1,800 worth of inventory, so we can subtract that out, and that tells us the amount we must have purchased would be 134,800. Okay, let's double check that. $134,800 is correct. Now that inventory purchased this period goes under inventory purchased in part 2 or step 2. Then we need to add in our beginning and ending accounts payable. So we go up here, beginning accounts payable is 21,250. Ending is 22,500. Okay, so if we take our beginning accounts payable, so how much we owed for inventory at the beginning of the period. This is assuming that all the accounts payables for inventory, because you could have accounts payable for other things. Okay, but just to keep it simple, this is all for inventory. So accounts payable for inventory, 21,250 at the beginning of the period, plus the inventory that we purchased during the period gives us a total that we could have to pay for inventory, 156,050, right? Total, but we only had 22,500 left over at the end. We're going to subtract that That means we must have paid $133,550 for inventory. Okay. So that's going to go right here. So it's a lot of calculations, but it does tell us how much we paid for inventory. Let's check that number. That is correct. Very good. And we can move on to our final formula here. Okay, not really final because then they're the totals. That's another formula. But here, these are other liabilities, other expenses that we are paying off. So we have accrued liabilities, beginning balance and ending balance, okay? Accrued liabilities. So beginning is 1150, ending is 900. And again, this would be for things like salaries payable, wages payable, taxes payable, any other liabilities that we have not yet paid. And we also need the expense on the income statement, okay? Here it says operating expenses other than depreciation were $27,000. So that's what it's talking about. And did I go too far again? Yes, I did. So $27,000 of other expenses. Okay, now let's go ahead and add these together so we get our beginning accrued liabilities plus the $27,000, whoops, plus the $27,000 from the income statement of expenses. That's $28,150 minus the 900 that are still owed at the end of the period. And that means we must have paid out $27,250. Okay, so that goes right here. So this is to other vendors for operating expenses, $27,250. Okay. And now for our final calculation, we got cash from customers. We subtract the money we paid for inventory, subtract what we paid for other liabilities / expenses. And that leaves us with net cash flow from operating activities, 136,300, right? That's what the calculator said. That is what, oh, went the wrong way. That's what we see right here. We're done. We did it. We got the right number. All right. So these are the answers here from the direct method. So this is the actual operating section of the statement of cash flow. Everything below that is just our calculations, which really wouldn't go on the statement of cash flows. But there they are for your reference. And we're done with 15 minutes to spare. So Jane, if you have any questions, let me know. If not, this is our final week, so make sure you get everything in by Saturday evening. If you have any questions, as always, either visit my office hours or just shoot me an email. And I wish you all a good summer break, or if you're moving on to managerial accounting and you're taking it on campus, maybe I will see you next semester. Okay, I don't see any questions, so we are done. All right, take care. Bye-bye.